After the recent collapse of FTX and the ongoing shady practices of many exchanges, the question on everyone's mind is, where can we safely trade crypto without worrying about a bank run? The answer might just be decentralized perpetual trading. Join us for the next 10 minutes as we explore what it is, how to take advantage of it, and how it could revolutionize the world of crypto. And yes, we'll even discuss potential opportunities to make money with this exceptional technology. But remember, this is not financial advice. We're here to educate and empower you. Welcome to the Crypto Landlord, where we simplify complex crypto concepts into life-changing knowledge that you can use to build your wealth and achieve financial freedom. Have you ever bought or sold something on eBay or another online marketplace? You probably noticed that buyers and sellers interact directly without the need for a middleman. Decentralized perpetual trading is a bit like that, but for trading cryptocurrencies and other assets. On traditional centralized exchanges, you have to deposit your money and often verify your identity before you're allowed to trade. This means the exchange controls your funds, and if they go bankrupt, you may lose your money. Decentralized perpetual trading protocols like GMX and DYDX eliminate this risk by operating on a decentralized network of computers where trades are executed through a smart contract. This means you don't have to trust a centralized authority to hold your money or execute your trades. Instead, you trade directly from your own digital wallet. Every trade is recorded and verified on the blockchain, which is like a digital ledger that can't be tampered with. So you can trust the code instead of trusting a middleman. Think of it like having your own digital piggy bank that you can trade with, instead of having to go through a bank that takes control of your money. Decentralized perpetual trading also enables you to trade with up to 50 times leverage without having to deal with the hassle and risks of centralized exchanges. So, whether you're a seasoned trader or just getting started, decentralized perpetual trading offers a simpler, more secure, and more empowering way to trade cryptocurrencies and other assets. Decentralized trading can seem like a mystery, but it all starts with understanding the concept of a perpetual contract. Think of it like a bet on the future price of an asset, without actually owning the asset. Perpetual contracts are like futures contracts, but they don't have an expiration date, meaning they can be held indefinitely. When you buy or sell a perpetual contract, you're agreeing to exchange the difference between the contract's opening and closing price, without ever having to take delivery of the underlying asset. The price of the perpetual contract is determined by an automated market maker system, which uses a mathematical formula to determine the price based on the ratio of assets in the liquidity pool. Liquidity providers deposit their assets into the pool, and they receive a share of the trading fees as a reward. Let us give you an example of how this works using GMX as an illustration. GMX is currently available on both the Avalanche and Arbitrum networks. Let's take a closer look at how users can provide liquidity and earn rewards by minting the token GLP. When you mint GLP, you are essentially buying a basket of different cryptocurrencies that the platform offers to trade with. At the moment, 35% of GLP is Ethereum, 15% is Bitcoin, 1% is Chainlink, 1% is Uniswap, and the remaining 48% is in stable coins such as USDC, Tether, DAI, and Frax. When buying GLP, you effectively buy these assets. The assets and percentages are constantly changing and may differ depending on what network you're trading on. For this example, we used Arbitrum as it has the most liquidity. By owning GLP, you are not only investing in these different assets, but also collecting 70% of the fees that the protocol earns based on your share of the pool. Essentially, you're betting against the traders. If the traders make good trades, they drain the pool of GLP. If they lose, they give money to the pool, which gets back to the liquidity providers. To summarize this, GLP owners earn or lose money based on price movements of the assets in the basket, fees collected, and traders' performances. New data shows that the majority of traders lose money, which means you have the odds on your side when being the house. Plus, by providing liquidity to the pool, you're earning rewards in return. The distribution of tokens in the pool may vary based on what the protocol chooses to offer and what assets require more liquidity. The more liquidity there is in the pool, the tighter the bid-ask spread, and the less fees traders have to pay. As a result, traders benefit from a more efficient and cost-effective trading experience, while liquidity providers earn a share of the trading fees and potentially capital gains from the underlying assets. In this way, the GLP token creates a mutually beneficial ecosystem that incentivizes participation from both sides of the market. Decentralized trading certainly has its advantages, such as being decentralized, transparent, trustless to a certain degree, liquid. However, there are also some risks associated with using DPPs. Smart contract risk is one of them, because the protocols rely on smart contracts to execute trades and manage positions, which can be vulnerable to bugs, errors, or hacking, leading to the loss of funds. Liquidity risk is another concern, as trading on smaller protocols with insufficient liquidity can result in losing money due to slippage. There is also regulatory risk, because DPPs operate in a regulatory gray area and may be subject to regulatory scrutiny, which could lead to increased costs or even a shutdown. Hacking risk is also a possibility, as the protocols are still vulnerable to hacks despite being decentralized. Complexity is another issue, as the protocols can be complex to use, and users may need to have a strong understanding of the underlying technology and market dynamics to effectively trade on the platform. However, we find that leading protocols like GMX or DYDX are beginner-friendly and easy to use, often more so than centralized exchanges. If you're considering switching to decentralized trading and are not sure which protocol to use, it's important to prioritize safety and reliability. We recommend choosing one of the biggest and most established protocols, such as GMX or DYDX. But please remember, this is not financial advice, and you should always do your own research. To help you compare the two, here are some key differences. GMX operates on both the Arbitrum and Avalanche networks, while DYDX is built on Ethereum. Both platforms are user-friendly and easy to use, but GMX offers a greater opportunity for leverage, allowing up to 30 times, compared to DYDX's maximum of 20 times. Both platforms use Chainlink's Oracle network to determine prices, which makes the prices the exact same on both platforms. GMX allows for a wider range of assets to be used as collateral, while DYDX only allows for USDC. GMX generally has better liquidity, but both platforms perform well in this regard. In terms of fees, DYDX is generally cheaper, with fees ranging from 0.02% to 0.05%, while GMX has a flat fee of 0.1%. However, if you sign up using our links below, you can get reduced fees for both GMX and DYDX. To sum it up, there are a few ways to potentially make money with decentralized trading protocols. The first option is to become an expert trader and make profitable trades on these platforms. However, this approach requires a lot of skill, experience, and risk-taking. For most people, providing liquidity for these protocols might be a better option. Of course, this also comes with risks, so it's important to do your research and understand the potential downsides. While the estimated trading volumes on decentralized perpetual exchanges are currently between 100 to 500 million, compared to the daily trading volume of over 5 trillion in Forex, there is still room for more trading activity. This whole sector could be a growing industry for many years to come, meaning that investing in great protocols may lead to earning a lot of money in the long run. That concludes our video on decentralized trading. However, we have more educational content coming up in the future, so make sure to subscribe to our channel and hit the notification bell to stay updated. Don't forget to like the video to help other curious individuals learn more about this fascinating technology. Thank you for watching.